Uh, Good morning, everyone. Thank you for joining us, and a warm welcome to this webinar, which marks the launch of our annual Building Products and Services publication. I'm joined today by some colleagues from BDO, and we're also delighted to be joined by Noble Francis, the Chief Economist from the Construction Products Association, and Ollie Cutting, who's the Corporate Development Director at a fast-growing services group with a very strong sustainability agenda called Hometree. We've got a lot to get through today, and in terms of the running order, first we're going to hear from Noble Francis on the economic outlook for the sector. Then we're going to hand over to my colleague Alan Chan, who's going to talk us through some of the M&A trends that we've seen over the course of the last 12 months. I'm then going to delve into the dynamics of that a little bit more with Ollie from Hometree, and then we're going to move to market themes, and Ollie's going to be joined by Daniel Gutman and Simon Pringle from BDO on that session. Then we're going to have some predictions from the panelists, and finally we're going to have some questions and answers from hopefully all of you. On those question and answers, we just ask that you use the chat function, please. So as we go through, if you could post your questions in the chat, that would be fantastic. And we'll try and save those up for the end, because we don't want to. We have got a lot to get through, and we don't want to sort of cover that as we go with the presenters, because they'll get a little bit bent out of shape on timing if we do that. So we'll save those up for the end. If you've got any technical issues, again, please just use the chat to let us know. And finally, you will be receiving a copy of this presentation, and I think the recording after the webinar. So that's great, and I'm going to hand over to Noble Francis. Welcome, Noble.
Thank you very much, John. And thank you for inviting me to speak here. If we can move to the next slide, then what I'd like to do is just very briefly take you through our construction forecast at the top level for 2024, 2025, and then highlight some of the key risks that are around, both positive and negative. Okay, so overall for 2024, we're looking at total construction output volumes falling by 2.2% this year. Now, that is overall for the sector, but it's very much a mixed picture across the key sectors. You have a clear difference between some sectors where activity remains very strong, and then other sectors that have endured a challenging 12 to 18 months and have hit that sort of bottom of the curve and are looking at recovery. And we're looking at that recovery stage over the next 18 to 24 months. So if we take some of the key sectors in turn, then on the second bar from the left, we have private house building, which is the largest construction sector by far. And if you look at the major house builders, they've all had falls in completions of around 20 to 30% last year. The first quarter of this year was challenging due to the poor weather, but there is an improvement in sentiment there. We've seen mortgage approvals improving, we've seen property transactions in the general housing market improving, and so we are looking that after the first quarter of this year, that we do see recovery primarily in the second half this year and into next year, but it is recovery from a low base. The fact that the first quarter has been so poor compared with Q1 last year is likely to mean that overall this year we have a decline, but the second half of this year is likely to be significantly better. And that's in line with most of the views of the major house builders. If you look at the second largest construction sector, then you're looking at the second bar from the right, which is private housing, repair, maintenance, and improvement. And that looks quite negative because it's had a challenging 12 to 18 months because of increasing interest rates, the cost of living rises, coming back down from that spike for the race for space during the pandemic. And so the -4% looks quite negative, but it is worth highlighting that it's a very mixed picture within private housing RMIs, very broad sector. And what you're seeing is that smaller discretionary improvements works broadly flat. The larger home improvements projects, you have contracts for those falling 12% last year, and some of that fall is likely to feed through into this year. You have the negative effect of the poor weather at the start of this year, but counteracting that, you have areas of very strong activity within RM&I. And primarily I'm looking at energy efficiency and solar photovoltaic. So within energy efficiency, you're clearly looking at areas such as insulation, which is very strong. You're looking at heat pumps and other heating solution systems looking very strong as well. And so the growth and the very strong activity levels of energy efficiency and solar photovoltaic are likely to offset some of the larger falls in home improvements for home office spaces, which are falling, and landscaping, which has been falling sharply over the past 12 to 18 months. In terms of other sectors, it's worth highlighting commercial. Commercial, which is primarily offices, retail, leisure, hotels. Our forecast overall this year is minus 2.9%, which clearly looks quite negative, but it is worth highlighting there's a very clear difference between some of those areas of commercial that are very poor in terms of orders and output, such as large commercial towers, which the market for large commercial towers peaked back in 2017. And clearly the fact that there's so much vacant office space currently, particularly within cities such as London, Manchester, Birmingham, means that there's relatively low demand for new, large one-off commercial towers. And exacerbating that, the few that are in the pipeline are just being pushed back currently because of the increasing construction costs and some of the issues based around the increases in interest rates, which means that financing costs have increased as well. Now, offsetting that low activity on new commercial towers and new large one-off retail developments, such as shopping centres, which is very subdued in activity as well, you clearly have commercial refurb, fit out, changes in use, changing offices, retail developments into residential in urban centres and industrial logistics on the outskirts of cities, which remains very strong as well. But historically, the commercial sector has been dominated by those large one-off projects. And so that's why we have a fall overall. But it does very much depend which element of commercial you're in. If you're in new commercial towers, activity is poor. If you're in refurb, fit out, changing the use of existing developments, and also biotech and data centers activity, then activity is at its highest ever levels. It's worth highlighting one of the key sectors where there's growth there, which is public non-housing, which is one of the sectors the ONS measures, which is an odd compilation of public sector building, but it is worth noting that there is growth there this year, primarily driven by the school rebuilding programme, which is prioritising schools that had RAC issues, which became very high profile summer last year. And that will only continue to increase going forward. Okay, if we can move quickly to the next slide, then this shows our forecast for next year. And clearly we're in a situation where overall in the economy, we've had GDP flatlining for the last couple of years, primarily due to that, the cost of living affecting consumption. But what we're forecasting for the UK economy is the back end of this year, as we get those interest rate cuts, as we get real wage growth, we get stronger GDP growth, and then next year, we return back to trend levels of GDP growth. And in line with lower interest rates, with real wage growth, we're expecting total construction output to rise by 2.1% this year, that right-hand bar. And the lower interest rates and lower mortgage rates should boost private house building, albeit from a low base, but we're expecting 5% growth in private new house building. More property transactions in the housing market should mean private housing RM&I increases by 3% next year, albeit from a low base again. And clearly that increase in private housing RM&I is going to be highly skewed towards energy efficiency and solar photovoltaic work. That race for space that we saw during the pandemic drove activity towards home office spaces and also better quality indoor space and outdoor space. But now the activity is shifting very much towards energy efficiency. We're expecting growth in most of the private construction sectors driven by stronger economic growth, but we're also expecting growth in infrastructure based around major projects work. We're expecting continued growth in that public non-housing sector I mentioned as well, which is driven by primarily the school rebuilding program. So if we can move to the next slide, then very quickly, in terms of construction risks, I keep being asked about the general election and whether that affects activity. In general, elections don't tend to affect activity down on the ground. Most of the activity down on the ground is based upon contracts that signed up to well in advance. What it may do is affect a bit of uncertainty just in the month before the election, and just you may see that some clients and some households doing home improvements projects just adopt a bit of a wait and see attitude towards signing up to new projects, but that's a minor blip, a minor delay. Activity down on the ground shouldn't be affected by that. What we may see once we get post-election, if there's a big majority, is that certainty of a government that is hopefully less chaotic than we've seen in the last few years, that certainty should incentivize a lot more spending from households, but also investment from major corporates as well. Materials inflation is falling on an annual basis, but materials prices remain 38% higher than they were in January 2020, pre-pandemic. So high materials prices are still an issue, even though on an annual basis, materials inflation is slowing. On the negative risks, my key concerns are based around construction insolvencies, which in the year to February this year, hit their highest level since the financial crisis. And so what we may see is that recovery in the industry does suffer a slight drag due to those insolvencies. And then the bigger issue, medium term, is going to revolve around skill shortages. Despite strength in construction activity in some sectors like commercial refurb infrastructure, UK construction has lost 347,000 workers in the last 5 years, and it's primarily those older age demographic workers, those workers between 50 and 64 years old. And we've lost them to early retirement, we've lost them to other industries. They're unlikely to be coming back. So if we move to the final slide, just in summary, private new house building and RM&I are likely to remain challenging for the next 6 to 9 months, but we are under that recovery stage. The key areas of construction activity in the second half of this year, going into next year and beyond, we're primarily looking at major infrastructure projects and frameworks. We're looking at commercial refurb and fit out. It's short term, very strong, and you can see that from your Overbury's of this world. Longer term, developers are going to be keen to do this work to avoid stranded assets due to minimum energy efficiency standards continuing to rise. Biotech and data centers remains very strong and will do medium term as well. Energy efficiency and solar photovoltaic I've mentioned already, not just within the housing stock, but in the non-domestic stock of buildings as well. And then the school rebuilding program is worth highlighting. But I always like to end on a negative because I'm a grumpy old Yorkshireman. So short term, my key concerns revolve around those insolvencies. And then medium term, who's going to be building all this activity that we need to occur in the next 2 years, 5 years, 10 years and beyond. And with that, I'd like to hand over to Ellen.
Thank you, Noble. Flip to next page, please. So overall, in terms of deal volumes, we saw that 2023 slightly declined by 2.4%. But I think the important thing is we look at the overall context of the market. Building products have fared very well, where the overall volumes fell by 20%, 25% in the wider market. So it's still a really strong sector. There's still a lot of appetite, and it's a really hot sector for doing activity. I think a lot of the things that Noble mentioned has created a more cautious investment, and I think it's important to look at the longer term kind of trends. And 2021 and 2022 were, exceptional years with the surge in deals following the COVID pandemic. Move on to the next slide, please. So looking at the overall picture, we saw buyouts down a little and cross-border activity also down, but not massively outside kind of longer term norms. This is probably unexpected given kind of just the wider environment, and also M&A cross-border integration adds a little more complexity, so not unsurprising that they've dipped slightly. The UK and the US continue to be really important markets for the sector. Over 65% of deals are continuing to be done in these territories. US fared pretty well last year, only a slight decline in M&A volumes. Interest rate environment had an impact on new build construction, but actually infrastructure investment was still high and driving a lot of interest, and actually a bit more of an optimistic outlook in the US. Europe was a bit of a mixed bag. So we saw double-digit declines overall in deal volumes, more pronounced in Nordics, Germany and Benelux. Actually, there were some bright spots in Ireland, Denmark, where volumes actually increased. Looking at the UK, we saw just over 10% decline in deal volumes. But again, you look at prior equity, with the interest rates and kind of with now inflation easing, we're seeing a resurgence of interest, and hopefully this points to a more kind of positive and higher level of activity in the coming year, and certainly back end of this year as well. Outside of Europe and America, we saw real growth stories in India and Australia. So the catalyst for deals taking place in these countries were government stimulus in infrastructure. So kind of driving a lot of deal activity in those countries. Moving on to the next slide, please. If we look at the UK then in a little bit more detail, we saw that, again, 21, 22, exceptionally high years, but in the longer term trend, 23 actually held up and was pretty good year in a longer term trend. So if you look at the activity by kind of the kind of manufacturing, distribution and services split that we analyze it by, manufacturing services dipped slightly, but distribution actually increased year on year. So this was driven by consolidation in HVAC and plumbing sector. So lots of Wolsey, UK plumbing suppliers made multiple acquisitions in a year. Merchant actually saw a lot of activity as well. So likes of IBMG, Grafton and Lords Group made a number of acquisitions. And also in the kind of energy saving space, we saw a lot of kind of distribution activity, for example, solar renewables. And with the need for electrification, we expect this to be kind of a hot area going forward. Finally, moving on to the valuations and volume by subsector. We see that kind of the of 11 subsectors that we track, all of them are showing a positive kind of variance compared to the longer term trend, the 15-year average. And in particular, worth noting that HVAC plumbing is the most active space. Particularly last year, we saw a lot of activity driven by heat pumps. Electrics and lighting, again, the drive towards solar and battery systems being a big feature in transactions. And the other subsector we've seen a lot of activity is materials, building materials and windows and doors. On the valuation front, kind of holding pretty steady, so 6.9 times compared to 2022, split between 6.8 times and 7.2 by trade and private equity respectively, and similarly listed multiples holding similar at 8 times as well. I guess the overall message is, despite the sector headwinds and the challenges, it's encouraging to see the valuations holding firm, volume activity remaining resilient. Understandably coming slightly off the post-COVID highs, but actually it's a really resilient and interesting sector for investors. Thank you.
Okay, thank you, Alan. So I'm just going to delve into that, the underlying dynamics of those movements a little bit more with Ollie cutting from Home Tree. So if we go to the next slide, please, Caroline. Yeah, so this is the same data set that Alan just presented, but it's cut between strategic and private equity. So financial buyers, the orange bar, and trade strategic buyers, the red bar. And what you'd see is that post-COVID, there was just a boom in private equity investment in the sector. And that dipped a little bit last year. It's still, big numbers. It dipped because of inflation, and that creates uncertainty for business plans. And it dipped a bit because of the interest rate rises, which compresses returns for private equity. And then if we just flip on to the next slide, the sort of consequence of that is more scrutiny. So deals have taken longer to do, and more work streams have been deployed. In particular, ESG, has become a big sort of aspect for due diligence, and cyber. We didn't see so much of that in the past, but we're now seeing a lot more sort of emphasis on cyber attack and IT systems, that they're still robust and up to scratch. And on the right of that slide, we see some of the underlying factors in the sector that have impacted, like energy rises and labour shortages and so on. So Ollie, if we can come to you, I'm just going to ask you for your perspective on this, please, as a industry participant. But before we do that, maybe just a few seconds on Home Tree Group, which is a really interesting group, very dynamic. Ollie, if you could tell us about what you're doing in the first instance, and then your views on the the deals in the market, please.
Of course, John. Firstly, thank you very much for inviting me to have a chat with you today. It is my pleasure. Here at Home Tree, what are we doing? So we're first and foremost a residential energy services company. What does that mean? We are aiming to be the number one sort of one-stop shop for the consumer, for the customer, in terms of the maintenance of sort of energy hardware in the home, but also the funding and the installation of all that kit. So we started life as a kind of a home cover company. So the AA for your home, your appliances, your boiler, your locks, your windows, your roof, all that good stuff is covered, and we have a network of about 5,000 multi-skilled engineers across the UK that can respond within sort of 24 hours to any problems in that sense. We've always had the view that sustainability is at our heart, and decarbonising the residential sort of built environment is our number one agenda. So with that comes our latest sort of buy and build strategy of renewable installers across the UK. So by that I mean solar PV, solar thermal, heat pumps, both ground and air source, and of course EV chargers as well. The third sort of string to our bow, if you like, is financing, because we want to help as many people adopt the new technologies as possible. So that's Home Tree in a nutshell, and what we're doing. In terms of the M&A and the deal market, what are we seeing? We're seeing a lot of variability in valuations, particularly over the last couple of years. So a lot of solar companies have been sold at very high multiples over the last few years on the back of a serious boom in the market, where you've seen wild amounts of kind of revenue growth from a market that was, very kind of buyer friendly. Very seller friendly. So the options for the customer were fairly limited, because the more established companies could support the customers. There was I guess a lack of really experienced companies in the market that could kind of deliver the installations effectively. There was also the perfect storm, right, of additional cash saved up over COVID, the energy crisis, cost of living crisis, and also the consumers' worry that potentially energy supplies could be cut off, given problems with Russia and Ukraine and all that good stuff. So where did we see ourselves coming in? We see ourselves sitting as a service provider. So coming from that sort of maintenance background, but being able to do the full installation and being able to be that kind of one-stop shop, if you like, for the customer.
Brilliant, Ollie. So one of the items on this slide is earnouts. Yeah. So you mentioned a second ago that you've seen this kind of massive ramp up in revenues of consumers have been at one point were desperate to sort of get solar to try and cut their electricity bills. What does that do for deal structure from your point of view?
So it makes it very interesting in terms of buying these kind of installation companies, and how do you structure that? As I said previously, that there have been some big valuations or some big multiples paid in the past. What we see in the installation sort of market is that these companies have very little recurring revenue. So they start the year almost on as a zero, and they have to go out and find new customers each year, and they are kind of spot installs. So as an investor or as an acquirer, it's very difficult to kind of put any sort of confidence on the future based on historical results. What that gives you is a problem, or a kind of a disparity between you and your seller or your target, because they clearly want to be valued off last year's results, absolutely booming year, grown 100% for the last couple of years. But we need the confidence that that's going to continue. And as I'm sure we'll kind of get onto later on, and also some insights from Noble, that's uncertain. So we use earnouts in our deals, in almost all of them, and it just helps bridge that valuation gap.
Yeah, no, I'm sure that's the case. You mentioned, and indeed we've seen that with other people in the sector. So I think people like Wix and Mighty and Agreco that have bought businesses, for different reasons to you, have also used earnouts. So it definitely feels like, that is part and parcel of the renewable energy market. You mentioned they don't have much in the way of recurring revenues, but does maintenance start to come through a bit more in this sector? Do we move from install to maintenance? And then I was going to ask you also about energy as a service, a little bit like kind of software as a service.
Absolutely. So in terms of the maintenance offerings in the market, sort of the traditional heating energy products in the home, your nasty high carbon sort of oil and gas boilers, that service and maintenance industry is well established, right? There are companies that have done very, very well in that market. We have in terms of our kind of core offering for the last 6-7 years. With the renewable sort of installation or the renewable technologies, these have been installed for the past sort of 10-15 years, almost as a sort of fit and forget product. And that's been how these installers have led their kind of sales pitch to the customer. These are relatively simple bits of kit, but certainly in the case of solar panels, very few moving parts. And actually, if they're installed correctly, they shouldn't really go wrong. They might need cleaning if you get some bird muck on them or something like that. But ultimately, you install them and they should just kind of work as long as you can monitor them. What we're finding is that particularly with heat pumps, the customer just likes a peace of mind product. There's something about a point of sale to the maintenance plan that gives the customer a peace of mind that says, actually, if something does go wrong, then we can come out and fix it. But also that kind of ongoing monitoring and inspection, I guess, rather than kind of a fixing point, is really important. So are the solar panels generating enough electricity? You know, are they optimized to perform in the right way? Are all your flow rates and your temperatures and everything in terms of your heat pumps working correctly? So we see that kind of ongoing monitoring as a really key point. In terms of the kind of energy as a service, as you say, we think that's a huge opportunity in the UK. So the opportunity to lease, for example, your energy hardware in the home and, you know, pay a monthly fee. You never actually own it, but you get the benefits of that. We see that as a huge growth area.
Yeah, no, very interesting. Excellent. So, Ollie, you're going to stay with us now, and we're just going to invite Daniel Goodman and Simon to join us. So if we could just move on to the next slide, and if Daniel and Simon can come along with their cameras. Daniel is a partner in BDO who focuses on strategy and commercial due diligence. So his job is to work with clients to, you know, look at the size of markets and the trends, the dynamics, and to interview some of the participants around what's likely to happen in that sector. Simon is our head of sustainability and ESG, and has also had a very strong academic career. So welcome, Daniel and Simon. If we could just move on one slide, please. So when you download our report, you'll see that we cover a number of themes in the building products and construction arena. I mean, the election, I think in many ways is good news that it's now, actually, because it puts off the, you know, let's not make a decision until later in the year approach. So I think we'll definitely see, you know, a kind of improved decision making and hopefully a higher level of activity in house building and infrastructure. And you know, Noble touched on some of that, and we're perhaps just a little bit more bullish on the impact that will make in the near term. But what we'd like to cover mainly in this session is sustainability. So as a theme, and I'm going to invite Daniel to kick us off on that, please. So over to you, Daniel.
Yep, thank you very much, John. Great to meet everyone and to have the opportunity to talk. Anyone who has attended last year's webinar will remember that we talked about the need to improve energy efficiency, but also about the barriers to roll out for these solutions and the complexity of the industry itself. I think, and partly we've heard from Noble about that already, over the past 12 months, what we've seen is that the energy efficiency market has really grown quite substantially. And that was driven by a number of factors, partly the funded market. So Eco4, which had a really slow start, really started to deliver over the last few quarters and is now, you know, still in the ramp-up phase. GBIS, which is another big scheme, is now really ramping up as well. But also the able-to-pay market is coming of age in a much bigger way. And what we've also seen, and that is something that Alan has mentioned as well, is that the deal market has really kicked off. And over the last 12 months, we've seen a whole raft of a number of different types of businesses all involved around energy efficiency, whether that is solar, whether it's heat pumps, whether it's Eco4, GBIS installations, and other solutions coming to market and transacting, all being prepared. And actually, as a firm, we're working on a number of these situations in a number of different guises. So, but the highlight of this section really is Ollie and Simon and the insights that they can provide. But just as an intro into this section and to set the scene, I just wanted to share a few slides and data points, some of which you might remember from last year as well, given that the overall backdrop hasn't changed hugely. If you can go to the next slide, please. So the built environment is a major contributor to overall UK emissions, and heating and powering of buildings alone is something like 40% of UK energy usage. And if you just zoom into the residential sector, something like 20% of emissions is driven by the residential sector, much of which actually is actually warming and heating rather than anything else. And therefore, this is a really big bucket that needs to be addressed in terms of cutting overall UK emissions. And that's not just because of the mission to reduce emissions, but it's also about fuel poverty, which is a real lived experience across the country, and that is something that we've heard a lot over the energy crisis in particular. If you can move to the next slide, please. So we read a lot about energy saving schemes, and there is a lot of activity in the market. But I think overall, it is fair to say that our progress as a country has been somewhat limited. What you see on the chart are two lines. The brown line essentially is overall UK emissions, and they have fallen quite substantially over the last few years. The vast majority of that, if not all of it, really has been driven by decarbonizing the energy sector. So actually leaving coal and introducing much more solar and wind power into the energy mix. So there's been really good progress. The bottom line is residential emissions, and they have barely moved over the last few years. So, still a big challenge to overcome over the next 5 to 10 years. If you move to the next slide, please. And this just shows some of those challenges. So these are the overall emissions from residential buildings, where we have come from and where we are bound to go to or have to go to hit our kind of overall net zero emission targets. So quite a large reduction that's still required. And that is complex. The good news is there are a whole range of technologies and materials out there that can help, and innovative solutions continuously get the markets. And as I said, various schemes are starting to really fire up, and the able to pay market is coming. But it is complicated. If we move to the next slide, just to help set the scene for why it is complicated. We've got something like 28 million homes out there. Can we just move to the next slide, please? So I'll talk while the slide is coming up. 28 million homes. It is the oldest housing stock in Europe. It's also the least energy efficient housing stock in Europe. So less than 50% of buildings have an energy rating of C or above, and that is a real issue. And that also feeds into the fuel poverty point that I made before. And every building is different, so no size fits all. So there's a lot of work that needs to be done to actually roll this out. If you think about a flat versus a single family home versus a tower block, the requirements are quite different, and the starting points are different, and the actual building methods and the building fabric is quite different. Specifically, if you think about something like Eco4, which is one of the big government obligations on utilities to roll out energy efficiency, there are very strict eligibility criteria in terms of which property qualifies, what type of tenant within these properties qualify, and then what kind of measures. And usually, actually, it is a whole combination of measures. So it's not just thermal insulation or a heat pump. It usually is 3 or 4 measures in one go that need to go in. And each of these combinations will be very different. So it is very complex, but we do know what needs to be done. And these schemes are now ready to start rolling out. If you could move on 2 slides, please. One more, please. So 2 key technologies that we hear about a lot, and Ollie has talked about them beyond thermal insulation, are solar PV and heat pumps. And for both of these, growth has really started to ramp up over the last few years, especially on the solar side. But in particular, on the heat pump side, there's still a very large gap between reality, which is essentially the grey bars on the heat pump side. These show annual installations, and government's aspiration in terms of annual installations. Quite a big chasm to kind of get across. And I think this is probably a good time to actually bring in Simon and Ollie. And maybe Ollie, if I may start with you, from your perspective, what are the key barriers to uptake of these various technologies?
Sure. So from our perspective, when we're looking at the residential sector, we see 3 key barriers to adoption. The number one is clearly cost, right? So, a relatively standard solar system with a battery will be upwards of 10K, and a heat pump, depending on size of house and wattage that you need, it's probably similar, probably a bit more. So it's a big outgoing for a home when actually they have existing technologies that work, right? So yes, there could be a sustainability angle from the customer saying, actually, I want to do more for the environment, but ultimately, do I want to spend my hard-earned cash on replacing, a boiler and, my connection to the grid that actually does still work? That kind of leads us on to the kind of the next one, which is the disruption to the home. So when you're putting in a heat pump system, it's not just strapping on a box to the side of your house and trying to get planning permission. It's actually, replacing radiators. It's replacing underfloor heating. Is the house appropriately insulated? So there's a lot of factors that the customer has to think about, and sometimes the answer is it's just too hard, or I can't be bothered. So we're trying to, help with kind of the education there and to help customers on that journey.
Yes, very interesting. And certainly when we do customer surveys, when we work on these kind of projects, that's very much what we hear as well. The cost is a barrier, as well as the overall complexity and actually just understanding where to get help and advice from. So maybe Simon, we've heard Ollie's perspective on key barriers. From your travels to the world of sustainability, and I think John mentioned you are, in our ESG hub, so you're having these conversations and thoughts as a day job.
Sure.
What do you see as key issues affecting uptake?
No, thank you, Dan. And just building on what Ollie's been talking about there, yes, of course, that kind of trade-off cost is a really important one, and we're in a place now where we hear about the cost of living crisis and people are trading off decisions in all manner of different directions. One of which is obviously around their energy decisions and the way in which they invest in their properties, if they actually are a homeowner, or the way in which they advocate to their social landlords or other landlords to improve the quality of those homes. So I think one of the barriers, just to build on Ollie's comment, is really around the way in which the supply chain has been evolved and developed. And we've had so many stop-start policies and funding ambitions and various other types of incentives over the last 10, 15 years across the UK, that what we have is a fragmented supply chain, and we don't have a coherent position in terms of the way in which this can be rolled out. Now, that's something I'm sure that Ollie will be able to pick up on later, and and it clearly links to the way in which things can be funded on a project basis as well. That's a missing gap. So how does this actually happen? Where do we reach out for in terms of that support and insight? And of course, as you rightly pointed out in your slides there, Daniel, we have a really difficult housing stock to deal with here in the UK. We have some modern homes that perhaps could have been designed to have energy efficient technologies or renewable energy built into them, but we also have an awful lot of 100-year-old plus homes that are quite difficult to retrofit, quite difficult to insulate, and represent a challenge in terms of the technologies that we have available. So I would say it's around an integration of policy and certainty so that we can actually get pots of money into regional areas, local authorities, combined authorities, so that social housing can be addressed, because that's a very big component of this. And then for those individuals who are able to pay or are homeowners, to make sure that they're the ability to reach out for information, understand their opportunities and potential, and actually find a way of funding it that makes good sense to them, given all the other trade-offs they're making. Those would be the barriers, I think. And that's, if we get that right, it's a triple win, really, because homes that are hard to heat are also really hard to keep cool as well. So as our population gets older, then this is going to correlate directly to the health and outcomes of our population, particularly the older part of our population. But it also draws people through into a higher skilled and well-paid industry, and creates those positive climate impacts too.
Yeah, no, very interesting, and clearly a range of barriers, some of which are easier to overcome and address than others. So Ollie, what is HomeTree doing to try to overcome some of those and address them?
Sure. So the number one thing we're doing is investing in our financing division. So we have a wonderful company called Be Warm, which we've rebranded as HomeTree Finance, that has always offered traditional sort of old tech sort of boiler loans and funding so that people could upgrade those. But we've moved very much into funding the kind of the renewable space. So breaking down that number one barrier, as I've said, which is cost, we have a suite of innovative finance options that essentially allow a much wider demographic to be able to afford this kind of improvement to their home and to their lives. Whereas sort of in the last 10, 15 years, it's very much been, either a government funded thing or I am able to pay and I am able to purchase this stuff outright. We can now offer, very, very competitive, sort of lower than high street sort of interest rates and costs on our financing products, so that more people can afford to get this technology. Our sort of key goal is a pay-as-you-save type product. So our aim is to be able to make the financing option as attractive as possible by spreading it over longer terms, as I said, using lower interest rates, so that actually the cost of this finance product, the cost of getting the renewable technology in your home, is equal to or hopefully lower than the amount of also higher than the amount of money that you're saving on your energy bill. So actually, sort of net, the consumer shouldn't see much difference in their monthly outgoing, if not see a small saving. And so we see that as a really powerful tool to supercharge this kind of really exciting market even further. As we've discussed, solar's gone through a huge boom over the last few years, driven by a perfect storm of energy cost, cost of living crisis, energy price rises. But actually, as we see sort of energy costs come down a little bit, there needs to be a new sort of drive, I think, to kind of help the adoption, and that's what we're aiming for. So that's the number one thing we're doing. The second is education. So people are getting better at understanding the benefits of solar and of heat pumps, but there's still a lot of myths out there in terms of, can I actually have one? Will it work in my home? I haven't got a new build, so it's never going to work. But as long as you are getting proper assessment from really good installers, I can introduce you to a few in our company, obviously, then there's no reason why it can't work.
Yeah, that makes sense. Maybe with an eye on time, just one last question before we go into predictions, and I think John has just popped up just to remind me of that. Just very quickly, Simon, on the commercial side, what do we see there in terms of energy efficiency? Kind of maybe the one or two key bits of insights you can give us.
Yeah, sure. Really quickly on that one, Danny. We have seen that maturing incredibly quickly over the last 18 to 24 months. And this is not just driven by regulatory requirements here in the UK and elsewhere. In fact, I've been working recently with a Polish business that has just set itself apart from a commercial perspective in terms of the way in which the BREEAM, the building standards, are met, and the business, the setting operates on behalf of the businesses that are going to be occupying it. And the reason for that is because, of course, the built environment from a commercial industrial point of view is the most tangible manifestation of the brand of the end occupier. And as those brand commitments become more robust and are becoming much more significant in terms of the valuation or the commercial positioning of that end occupier, then they need to see that reflected through into the built environment as well. So yes, we're seeing, absolutely regulatory drivers. We're seeing a real recognition that embedded carbon is key, as many people on the call will know. Around 90% of the carbon impacts of an industrial setting is embedded, and 10% is typically the figure we use in terms of operational. But it's the way in which that setting represents or articulates the brand proposition of the end occupier, and that is becoming a really powerful driver in terms of changing design protocols, procurement protocols, and the way we look at timber-based or cement-based or steel-based or recovered steel or whatever it might be, products that come into those buildings. So heavy, non-regulatory, strong commercial drivers flowing down that sector.
Great, very interesting. Thank you very much, both, and back to you, John.
Yeah, thank you very much. So if the three presenters could stay with us, and if Noble could join as well, we're just going to turn to predictions. So next slide, please. So these are predictions for the rest of this year, second half of 2024, and looking ahead into 2025. I'm going to hold you to 60 seconds each, actually, in the interest of time. So, Noble, over to you.
Thanks, John. I tend to waffle on, so 60 seconds isn't very long. Short term, in terms of second half of this year, next year, and also into the medium term and long term, I think we're looking very clearly at some of the areas we've been discussing in the last few minutes: energy efficiency and solar photovoltaic. Not just individual measures, but you are looking very much at heating and energy solutions. That's not just on the private housing stock, that's also looking into the commercial refurb, that stranded assets issue I was mentioning. You're not only looking at private sector buildings, but you're also looking at public sector buildings where the Social Housing Decarbonisation Fund is directly funding activity on the social housing stock. And you're also looking at the public sector decarbonisation fund, which is directly funding retrofit activity on government buildings and all public sector buildings generally.
Thank you, Noble. Ollie, over to you, please.
So I think in terms of the general market, I think we're going to see a continued growth in the adoption of solar. As I say, we've been through a big boom, and I think that's going to continue. If you look outside at your roofs, there are very few actually with panels on, so I think there's a lot to go for, particularly with financing solutions like we're bringing to market to make that more accessible for more people. I think we're right at the start of a growth in the heat pump market. I think we are 10 to 15 years behind our European counterparts. So again, a lot to go to from there. We need the government to do more, I think, to help in terms of incentives and in terms of trying to drive that growth. And another trend I see is the kind of the heat or the energy as a service coming through. So with kind of lease products, taking that kind of ownership out of the customer's hands and actually just, why don't I just pay for my heat on a monthly basis or pay for my energy like that? In terms of the M&A outlook, I think the volume of transactions is going to increase over the next few months, certainly towards the end of the year. We see a softening in valuations, just from an absolute peak over the last few years, particularly in the space that we're looking at. And I think there's going to be a lot of appetite, a lot of buyer appetite from the likes of energy services companies, but also the energy sort of supply companies looking at exciting renewable installers to acquire.
Very good, thank you very much. I'm resisting the urge to ask questions because we've got that coming up in a moment. So, Daniel, your predictions, please, for 24 and into 25.
Yeah, I think we covered the energy efficiency point already, including the deals market that is going to get hotter. So I definitely agree with that. I think skill shortages will persist and probably worsen over the medium term, and that will be an issue across all sectors of construction. But I also think the wider sustainability theme is just weaving its way through it. So I think deconstruction, reuse will become more important as we go along. Penetration of off-site assembly type technologies will become more important for the same reasons, partly driven by labor shortage, partly by sustainability considerations. And I think the overall use of technology is going to continue to permeate. So that's Internet of Things, it's BIM 2.0, it's digital twins, just to help efficiency, sustainability, and energy usage across the estate.
Thank you, Daniel. And lastly, Simon, just from your perspective, please.
Yeah, so agreeing with my colleagues and the previous speakers, I think to build on all of that, I would suggest that we will see an active market response to address what is essentially a broken supply chain system, and there is a huge opportunity associated with that. So retrofitting the residential market, particularly those harder to treat properties, which are in some of our post-industrial cities, huge opportunity, but it's going to rely upon some new and innovative funding approaches and a rebuilt skills base and supply chain. And that might link, I would suggest, to a post-election push to join up the thinking around some of our key challenges, which are all linked. So looking at the way in which our aging population, the just transition issue, some of our poverty issues, the skills shortages, and of course the climate targets, all linked together and shouldn't be separated out as different points of governmental focus. Link those together. Let's get some funding certainty around it, and let's let the market respond. And then somebody's going to make quite a lot of money out of this, because it's going to have to change, and they'll have to change very quickly.
Yeah, and let's very much hope that is the case. So stay with us, panelists. We've got Susanna's been looking at the Q&A on the chat. Susanna, any questions, please, for the panel?
Yes, so the first question we've got here is one for Simon. So this says the forecast for carbon emissions shows embodied carbon falling to near zero by 2050. Regulation and legislation will be required to drive this, but there is none for the built environment at the moment. Are there any indications that a Labour government will legislate for embedded carbon in buildings?
Well, that's a very specific but very good question. I'm afraid, Susanna, answer the question. The answer to that is I don't think so. That's really quite a complex space. Could it be done? Yes, absolutely. And it's a highly tangible, part of the economy, and there are certainly points of leverage around the key components of the built environment that can be addressed. Although we know, if we look globally, cement concrete is around 8 to 10% of the entire global emission footprint. It's absolutely huge, and we've experienced, and I think I've talked about this before on previous podcasts, around the adoption of, say, structural timber versus recovered steel and so on and so forth. So let me just give you I don't know the answer to that question, but I will look into it, and I will be able to feed back to the participant group, if that's okay, via you, Susanna.
That's wonderful. Thank you very much. And then obviously, because the elections are just around the corner, what might we expect to see from the next government, and what do we want to see from the next government? Daniel, do you want to answer that one?
Yes, I can certainly give it a start. So I think what I would want to see is stability, a framework to look forward to for 5 or even 10 years, what the kind of direction of travel is, how that might be funded, and how it will be enabled. Most importantly, we talked about skill shortages, etc. So I think that is really important. And I think that is underpinned by carrots and stick, as kind of touching the previous question around embedded carbon. I think what we will see, and what we hear from conversations that we're having, that there is a really heavy focus, a strong focus on the green agenda. There's this decarbonization of the built environment, its renewables, etc. There will be, to all intents and purposes, a larger fund available, or more funding being obligated, so let's call it this way, for publicly funded measures such as ECO. So there will be, in all likelihood, ECO 5, which will be larger and less disrupted than ECO 4 would have been. That's certainly the plan. There might be some changes on how that will be delivered, and where the responsibilities lies to just evolve it a little bit more into local authorities, etc. But the overall direction of travel certainly is positive. But there's a lot of enabling and envisioning and lifting the fog that needs to be done as well.
Great, thank you. And then just one final question. This is for John on the M&A market. So there's been a lot of activity in renewables, and fire has been a hot sector as well over the last year. Are there any other sectors that you're keeping your eye on?
Yeah, I think, those two in particular, we think we completely agree that the activity level will carry on. I think off-site environment, so off-site build, that doesn't necessarily just mean the whole house. It means components going into the house. We think that continues to be an interesting area for M&A. And then I would say merchanting, distribution. Alan shared some of the statistics on that, and we believe that will carry on. That there'll be quite a lot of activity in distribution, particularly specialist distribution. And some of those groups, looking to create additional value by buying businesses that have got a fabrication content to them, so sort of higher margin. And we've seen that, for example, with Grafton and a business called Stairbox that they purchased a couple of years ago. So I think those would be the areas from our perspective. So, look, I mean, we're just coming up to the hour. We could go on for some time, but we probably shouldn't. So you've all got your days to get on with. So thank you very much indeed for joining us, and to the panelists and presenters, thank you very much again, for your contributions and thoughts and insights. As we said, we will send around the slides, and I think the sort of recording of this afterwards, and it will be possible to download from the website this year's publication. So thank you for joining us, and enjoy the rest of your day. Thank you.